ZNO Group Limited, or ZNO, has released a interim financial report today alongside the company announcement for this quarter. But we'll go into the half-year results first. So remember, these aren't quarterly numbers, these are half-year numbers. So we'll scroll down to the meat of the announcement. So we've got revenues are up, and mind you, this is comparing not to half one of last year, but the second half of 2018. So we've got half two and half two. So we have 1.7 million in revenue, has gone up quite a bit. Cost of sales, of course, have doubled as well as a result. So gross profits are looking healthy, but then we've got to factor in all the fees associated in running the business. We end up with a position that's about half. So we're losing about half as much as the previous year. So that's quite healthy. It's not too bad. It's a good story so far. And we have cash and cash equivalents, of course, it's less because we're losing money, obviously. So we've got current assets at 3.9 million, 2.7 cash in the bank, which is a good position to be in. We've got assets roughly about the same. It's not growing. And liabilities are slightly increasing, so that's not too bad. Overall, net assets, 3.1 million. It's on a decrease. Still, we're looking fine. Equity, that's the important part, 3.1 million. Yeah, look, we're in a decline at the moment. We're still in a decline, rather, so it's not too bad. The overall financial position looks fine. It's getting better. But the important part is this part here. Before I dive into this document, let's have a look at the annual revenues for last year. So we saw the half two revenues, and these are the half one revenues. So we end up with 652K plus the 1.7 million from half two, and we end up with a total of 2.3 million in annual revenue. Now keep that in mind as we look at the share price and the market cap. At $2.40 here, the market cap was just under $400 million. So at $400 million divided by the revenue for last year, we end up with 170x revenue, which is crazy high. So most companies, as a rule of thumb, when they're established and settling in, they sit around 3x to 7x annual revenue, depending on the sector and depending on what's happening. But as a rule of thumb, 3 to 7x is pretty reasonable. Sometimes you'll get a sector that's really running hot, like say Afterpay in the fintech sector is running at around 10x the last I checked. So 170x is pretty crazy high. But closing price today was $1.67, so we're sitting at a market cap of $272 million, which, if we calculate the revenue, is we're still trading at 115x revenue. Now, keeping all that in mind, let's have a look at this company update. We are sitting at 30K to 50K per day in online sales. Now, the interesting thing here is they're sitting at, let's say, 30,000 multiplied by 90. So for the quarter, they'd be sitting at 2.7 million, or for the first half, they'd be sitting at 5.4 million, which is a lot more than the 1.7 million they made last half. Now, the question is, are these online sales coming in through the China and Singapore revenues that they mentioned earlier on in the past few weeks? Or are these separate? Are these just, you got your 1.5 million deal with both China and Singapore plus the additional online sales? Well, let's have a look at what the numbers look like in both scenarios. We take the bottom end of this range here, 30K, and we multiply that by 365 plus 3 million for the China and Singapore deal. We end up with just under 14 million market cap. So we currently have, at today's closing price, 272,210,000. And we divide that by 1395, and we end up with a revenue multiple of 19.5x. Now that looks a little more reasonable. If we take the bottom end there and assume the China and Singapore deal are separate from these online sales, we end up with a market cap target of about 80 to 85 cents, which would be a good horizontal target here. Now let's assume we're at the top end. So we've got 50,000 times 365. So we end up with 18 million plus 3 million from the China and Singapore deal. So we have 272 mil, 210,000, and that is the market cap divided by 2125. So this is looking more reasonable. 12.x annual revenue, assuming all these numbers, and this is a big assumption here. We're only 1.5 months into this year, and we're just assuming these numbers are going to be accurate throughout the whole year. The 12.x, even that's kind of high. So if we factor in the top end at 12x revenue and the bottom end at 19x revenue, both of these numbers are still quite high. And there is a lot of risk and assumption involved in this. Firstly, the assumption is that the China deal and the Singapore deal are excluded from these online sales. I don't see any clarification on this one. I don't know if the deals, the exclusivity includes online orders or if these are separate. So it's worth factoring in that there's no clarification on this. These progressions of significant future deals, I mean, that's just speculation. Again, got to be factored into the price. It is speculation. It's also speculation that these numbers will carry on throughout the rest of the year. Now, keep in mind, coronavirus is in decline at the moment. You're not going to have these sales probably for more than another month. And then after that, then what? So these numbers exist because coronavirus is active right now. These numbers won't exist at the end of the year. They won't exist even in June, maybe even in April. So you've got to factor that into the reality of this stock. Sure, the speculation's high, but will coronavirus last forever? Probably not. Will these sales numbers last forever? Probably not. So even at 12x annual revenue, that's still really high. You'd be looking at perhaps 5x revenue. So if we assume even at the top end, sorry, let's say the bottom end, we multiply that by 5. Something reasonable, 106 million market cap. You can calculate that for yourself. But that'll probably be a reasonable market cap to have this stock at. Just food for thought.